All right, so I decided after a tweet this week where I talked about forecasting recessions being a losing game, and this was in direct response to the fact that the drums were banging. I don't know how many times this has been over the last 3, 4 years of the next recession, but because there is an obsession with recessions, I figured I would do a webinar video on really the way I think people should think about recessions, why people are worried about them now, uh, the fact that I would say there is a recession that's going on right now, what needs to happen for the one that people are looking for that's not present now. So, what kind of indicators to look at and try to hopefully convince people. I've talked about this for a long time over the last really 3, 4 years that we're past the point of business cycles. And instead of business cycles where you actually have recessions, where you lose 1.5 to 3.5% of jobs, we're just going to keep going from regime shifts, and the business cycle has been replaced by when there is a synchronized fear of recession. And I think right now, both the Fed is leaning towards the fact that inflation and the unemployment rate have reached levels where they can start to cut rates. And it comes at a time when people are more worried about recession for real reasons. So I want to go through this, and at the end of this, I really want to make the argument of something as to why there's no business cycles, of why this time is different. I've called this the garbage in, garbage out time, where people that are following business cycle type indicators, signals, data, that they're ignoring where we are. So here are the major differences, to me, as to why this is a different period of time and how people should not be thinking about this from a deep recession. One is that the debt is now held in the public sector instead of the private sector, and that's a big structural change. At the same time, we have a change that's happened in terms of the economy from the cyclical manufacturing, housing related side to the service side, which is less cyclical, particularly with the iPhone and obesity or healthcare expenditures. How software and AI combined have contributed to profit margins going higher, and that we will have periods of time where job losses, or let's say the lack of hiring, is going to go on. But not to think that this is a cyclical signal, but more the fact that at times we overshot, and now we're just at a period where the job situation has a lot to do with just kind of a slowing down. And I think we're going to hang around a much lower level of job creation than we had, because profit margins are going to get better or stay sticky at higher levels as AI efficiency and productivity gains combined with the software gains that had come, or the benefits that had come from 2007 on, are integrated. And I just want to leave this before I go through the charts with a quote that Elon Musk gave on a podcast I heard recently, but he said back in April. And for those of you not involved in AI on a daily basis and just kind of reading about it, if you're not using it and you're not noticing how much the improvements are going, what Elon Musk said was the amount of dedicated AI compute looks to be growing at about a factor of 10 times every 6 months. And his point was that means that each year, at least for the next, say, 3 to 5 years, you'll be dealing with 100 times improvement. So things are just moving much faster, and that's going to show up. And that's why at this point, with AI kind of leading the way with efficiency and productivity, it's going to have an impact on top of the things that I mentioned. So let's quickly go through why now a recession. It's the SOM rule. If you look at this long-term chart back to 1950 of the unemployment rate, which is the white line, and then the recessions are the shaded areas, every single time we've seen a 100 basis point increase from the lows in the unemployment rate, we've had a recession. So there's valid reasons at this point based on that for people to focus on it, and they have. If you look at temp hiring, which is the white line, and you look at the unemployment rate inverted, this has been connected, and temp employment peaked in the beginning part of 22, right at the beginning of the Fed rate hikes. And what you have is temp hiring has been going down at a pace which historically has meant that the unemployment rate's going to rise. So it makes sense that people should be worried at this point that we're headed into a recession. If you do that same chart of temp hiring overlaid with total employment, this is where you would, based on history, you would expect that we're going to see a quick loss of jobs. If you go to IP, this is industrial production year over year, the white line, it is negative right now. If you go back and look at every single time it's been negative by any amount, going back to 1920, that has been a recession, except for a brief period in here during the Great Depression, and then one more during the commodity or the energy fall off back in 15 and 16. Aside from that, we've been sitting at zero now for over a year. So this is where you'd have to believe something is different, because every other time that we've had IP at negative, and granted, it's not massively negative, it's just slightly negative, the industrial production is telling you there's a recession. At the same time, this is the PMI. This is the 10-month average of the ISM, which is sitting below 50. And you can look and see that if you want to have a good signal, typically when you're down at these levels, and the only real time where we got down to these levels was back in 96, which I think was, it was a mid-cycle slowdown, but regardless, you had a period here that was fairly close, which was during 85. But other than that, going back to 1975, they were all recessions. So the manufacturing side is in a recession. Using the leading economic indicators year over year, also never been at these levels going back to when the LEI was basically created year over year. You're at levels that have been a guaranteed recession over time. And we're not slightly down here, we're way down here. So on that basis, it wouldn't be surprising if somehow or another, people want to look and say, hey, we were in a recession. If you look back, if we start seeing job losses, the recession may have started a year ago. Jobless claims have gone up this year. I think on top of the SOM rule, we're seeing weakness in the claims data seen through the 4-week claims. This is the continuing claims, which again, have had a very sharp up move. I'll get back to this chart later on. It's part of the structural comparison as to why this is garbage in, garbage out. But claims have been trending higher, which means people are losing, not only filing for unemployment, but they're staying or continuing to be unemployment, which is an indication that the being able to get a job once you're out of work is not as easy. This is commodities in terms of the raw industrial. So despite the fact that we have this big infrastructure boom and this move to green going around the globe, hearing that copper and energy and all these things would go higher, we've been in a commodity secular bull market. This is commodities year over year. So this is the CRB raw industrials year over year, and it's negative right now, but more importantly, year over year, it's been negative since 22. These have preempted or been during recessions. Typically, you've had lots of times where it's been negative after overshoots, but China is the major driver of this, and the reality is this is another reason why people have been scared. Consumer confidence peaked in 21 all the way up here. This is the conference board. It's down to 100, which basically is slightly lower than it was in September of 20, which we were still in some massive lockdowns around the globe or just coming out. We were still wearing masks. So to think that consumer confidence is as low as it was during COVID just shows how negative people are. If you use the Michigan, which is the white line here, we actually hit a 45-year low in the Michigan consumer confidence back during the worst in inflation. It has bounced back somewhat. You're way off the highs. And overlaid with this is small business optimism related the profit component. So small businesses are sitting at the lowest level of profits in the survey, or near the lowest, really since 2010. And the only time you think about the great financial crisis was lower. Aside from that, you're dealing at levels around 70 that are really the lowest in 45 years. So individuals are negative. Small business owners in terms of the profit side are negative. Housing, which was directly impacted by the rate hikes, also by inflation with house prices going higher, you have the housing affordability index, which is still sitting at the worst level. So it is just, 40 years, it is hard for people to go buy houses. And so sentiment on that has gone low. And you can see that in some of the other data with housing affordability at levels that are low. That's why we're sitting near 25-year lows in existing home sales. So this is existing home sales. We're at levels that, believe it or not, are only taken out by the worst of the housing bubble, post the housing bubble, and post the ability for people to get mortgages. So you have a stock market making new all-time highs. You still have house prices going higher. But again, one of the reasons that I think people are seeing the negative side is the fact that the housing market is just not moving, and the auto market's been impacted too through rates moving higher and the inability for people to get leases. That does show up for those two categories in consumption. So personal consumption of durables, year over year is negative. So you can see over time when you've had negative, except for this one little period, and again, we are barely at negative, but we are negative. You don't have a recession. I just want to highlight these two here were both mild recessions, both in '90 and in 2000, where the stock market was hurt here. It wasn't hurt too badly here. I want you to remember those because, as I've talked about in terms of how much people worry about recessions, recessions were much more likely from 1920 to 1970. Then in the 70s, we had, from 70 to 84, we had some inflation driven and rate hike driven ones. But then when you go from 1984, the tweet that kind of got people going in terms of this, only 7.5% of the days over the last 40 years has the U.S. economy been in a recession? And two of those, these two in here, were fairly mild ones. We obviously had the great financial crisis, which is an unwind of the housing bubble, and then we had COVID that people think about. But we were already towards a past when computers started to involve our lives and the structural change happened in the 1980s, and we started to have the massive increase in debt, which subsequently was shifted in here. And then with the rate lowering in here down to zero, you had people refi and move to lower rates. You had corporates that went through the restructuring. So I bring that up just because when people are looking for recessions, we've already been in a period of 40 years where it's very hard to have them. And so calling them to me, like I said, it's a losing game. One of the other things that has had people fixated on a recession really since 2022 is the fact that the yield curve has been inverted. And remember, that was headline stories. It doesn't get as much press now because we're still inverted. Now with the Fed cutting rates, if they grow aggressively enough, maybe we'll actually see it get inverted for a period of time. But I highly doubt we're going to get, back above zero on 3-month bills versus 10-year rates unless we have a dramatic pickup in inflation, which I don't see happening. But I do think there's very likely going to be a bounce back in inflation next year, and that'll be the story of next year for the next regime. For the time being, we have the longest time in history with an inverted yield curve, and before these times, it led a recession. So we'll see what happens, but again, I'm just bringing up the points that have made people fixate on this concept of recessions and where these things have been. Now, in terms of indicators that I think people should be going, my team and I, we spent a lot of time in 2005, 2007 trying to create a recession model which used real-time asset prices and the most timely of data. And the number one thing that I wanted as a signal was year-over-year S&P. And the reason was, before job losses came, you had profits that were peaking and getting more tight. You had a lot of signals with inside stocks where revisions were going lower. So year-over-year S&P has traditionally been a very good guide, and that's what we have here in the white line. The reason I want to show this, we're currently at plus 28%. If you go back over time and look at the periods before here, you can lead something like we were here. This was the great financial crisis as we went in. We were up here, and that led by about 6 months, meaning we got there. But we went negative at some point. So you're going to need to see the S&P either have a sharp fall, or what happened in '07, we started to go sideways in the S&P. We had falls, we had starts. We got a recession signal on ours. Because this was down here at that point. We got it in October of '07, so it was down at 12%. But some of the other things we used, which I'll go through, were junk spreads year over year and also claims year over year, neither of which right now is close. But then the other thing was consumer net worth, which was also going down back in '07 because stocks were starting to go sideways, but housing was already becoming an issue. So you need to see stocks year over year start to go down. And just to highlight again how important year-over-year S&P has been as a signal. This is just it overlaid. Here are the recessions again. I took this time the 2-year because again I said it leads. So what we used to do was take the 2 year-over-year S&P. So looking at the rolling 2-year rate of change, which currently is at 40-ish%, way up here. It generally was getting down to much lower levels, which again means that you start to kind of peak in stocks. It's generally not some big upswing and then move lower. And this is overlaid with the service PMI. So not the manufacturing, but the service. So you need service to be down below 50, which is what happened in here. We're currently at 52, but you also need the S&P on a 2-year basis, which again, we're not close to. So we're going to need to see a lot more weakness in the S&P. And as I get through some of the other things going forward, we're going to need to see other things happening too. This is just that your 2-year rate of change on the S&P overlaid with small business profits. So I showed that small businesses were very negative. If you're missing profits on this, you would expect that this would be down too. But the small business optimism of profits has been diverging from not only the S&P, but most corporate profit side. And I think a lot of that has to do with what's happening and how bigger companies have had more of an edge here. I mentioned profit margins at the beginning. This is one way to look at profit margins. This is basically looking at corporate profits growing relative to GDP, nominal GDP. So we have corporate profits growing faster than nominal GDP. So profit margins are sitting up here. You can see what was happening during the period leading into the bubble growing. You had profits slowing down relative to GDP. In this case, you have profits sitting up here. So I do not believe that this is anything like 2000. We're going to need to see a sharp drop-off, which is what happened here leading into the great financial crisis, which we started to see profit margins come down, which again makes sense. That's not happening right now. So profit margins are still sitting up at sticky levels, and I would expect that AI is going to have this continue. And this is the S&P earnings forecast. So this is the forecast for S&P earnings relative to nominal GDP. So the only time we have recessions, nominal GDP goes down, which you can see here, and S&P earnings forecast, the revisions tend to lead. That hasn't happened here. So again, we're not seeing anything on the S&P side that is showing at this point that there's a recession that's coming, and it's actually a leading indicator in terms of the prices. So on the stuff I mentioned that we've kind of left this world of the cyclical-based economy. What is a cyclical-based spending? Well, that's durables. I showed that durables were negative. The opposite side of durables is the fact that here's the service year over year, and this is overlaid with GDP year over year. So GDP year over year right now is 3%. And it's being driven by the service side on consumption. So service spending is still close to 7%. And more importantly, this year it's actually gone higher. So we're going to need to see a dramatic shift in spending on the service side, which is not there. And this is one thing that I really want to make clear as I kind of go into the next part of this, is that when people look at this economy, one of the structural things that I don't think people have fully come to grasp with is the fact that the ownership of wealth in this country and of income in general is really driven by the top end. And that's kind of the part here as to what we're dealing with. When you're dealing with an economy of medium income or the medium spender, medium income person, they're getting impacted dramatically. 2/3 of spending on an annual basis is happening from the 40% or the top 40% of people in the country in terms of wealth. That's a scary number in terms of trying to forecast a recession, because really what you need to happen is for the wealthy people to drop off their spending considerably, and that's just not happening. And so you're left with a point that until we see a dramatic change in housing or real estate, and we see a dramatic change in the stock market, you have consumer net worth, which is too big. In terms of helping people at other ends of the spectrum, I highlighted this chart. Now this is inverted housing affordability. So even though house prices are as difficult to purchase for individuals, especially at the bottom end who need mortgages, as they were in 2006 before the housing bubble leading to the great financial crisis, this white line here is household debt servicing of mortgages. So here we are, this is where we were, meaning debt service was very high and it was going higher. People were taking out more debt. Now you have the debt service sitting at the lows of lower than it was in 91. So you have a lot of people sitting with equity in their home. They can't get out of their home, which is why existing home sales are so low, but their debt service is much, it's not a burden the way it was back then. I want to go back to the claims. You remember I showed you the continuing claims and I said, yeah, it has trended higher. This yellow line here is where it is right now, the 1.86 million people that are out, that have been on uninsured or unemployment insurance and are continuing to be on it. This is where they are today. This is the history of it, and you can see that when continuing claims go higher, it is a recession. The problem is We are sitting at the lowest levels, even with the rise we've seen going back to the 70s. And again, this is not population adjusted. So claims are extremely low. This is not a problem. And you're going to need to see, I mentioned continuing claims were a big part of our recession model. Despite the fact they're up year over year, it's not there. And I showed this in the last webinar, but it's important for people to just realize the right scale here is in millions of jobs. The orange line here is the total amount of people employed, which is about 160 million. The red line here is healthcare jobs. When we had the last cyclical recession, which was during the great financial crisis, healthcare jobs had just started to take over the white line here. The white line here is retail jobs. This is manufacturing jobs. And this line is leisure and hospitality, which obviously also benefits. So the demographics favor, because of obesity and being overweight, the healthcare jobs, which continue to go higher and are correlated with the overall jobs. You have hospitality and leisure, which again is a travel for this. And then the white line here is basically unchanged since 2000, and the manufacturing jobs are below where they were in 1990. So garbage in, garbage out. Anyone looking for the cyclical part of the economy, it has changed. It is now about government and demographics. So if you think the government is going to start firing people as entitlements and the deficit remains at these levels, that's where you're betting on. Kind of the final four charts here. I just want to bring this one up because this white line here is junk spreads inverted. You need to see a widening of junk spreads. This will be the one indicator which is going to show you when a recession is going to happen. The orange line here is year over year LEI. So remember, I showed this all the way back to 1960, that LEI is at levels that historically have been a recession. Well, junk spreads are at periods boom times. They are not at periods of a recession, which are generally when you've had this widen out. The reason I have this red thing here, this little move here was SVB. And I remember doing webinars and talking to people that what that proved is that the government, like it did here, has unlimited ammo because of the great financial crisis, which is another structural difference. The Fed has tools to be able to put in place to deal with this. Historically, if a bank like SVB went out of business on a problem that were so many banks, and then we subsequently had 3, 4 more banks go out of business, you would have expected more of a contagion. But they fire hosed this because of the tools that were created during the great financial crisis. Garbage in, garbage out. This is a completely different world with regards to the Fed tools as well. And this is just showing junk spreads, and again, just with the recessions in there. So it can happen quickly like happened here, but normally what goes on is spreads start to weaken well in advance. So, and this is junk. So if you want to pay attention to anything, look for junk spreads and see if they widen out. I heard a lot of people saying junk spreads were widening out. That's just not the case. They widened out in terms of CDX. They widened out in a few things, but it's not about things happening short term. It's about them staying out there, blowing out. Last two charts. This is probably the thing that I mentioned about how wealthy the top 40% are now in the country. You're dealing with a situation where the top 40% in the country own, I think it's 80% of all the net worth in the country. The total net worth in the country is now $160 trillion. This is how much, these are the annual changes, increases. There's a decrease here. But you're dealing with the 4 biggest annual increases, which when combined get to about, you've over the last whatever years, you had 13, you had 15, so that's 28. You had 18 here, so that's 46. Then you had a decline of 6, that's 40. $50 trillion, or 2 times GDP in the prior 5 years. And so far this year, we're already on pace for another over 10 trillion. You just have more savings than you can imagine in the element of consumer net worth. And the reason that's important is because of this ratio. This is the ratio of the 160 trillion to GDP. GDP is about 26 trillion, so you get 160 trillion divided by 26 trillion. You have 5.6 times GDP in overall net worth, not in asset values, net worth that takes into account the liabilities. I already showed you the debt service. Where we were when the baby boomers really started their ascent was about 3.5 to 1. I would expect that over time this is going to migrate back down there, but that's going to make it very difficult to have a recession because you have a tremendous amount of asset wealth, which is not only gives people the cushion to sell some assets, take some cash in. But as the demographics kick in, that wealth transfer goes on, you're giving more money to younger people. It's one of the reasons why crypto is my favorite story for AI, EM, but also against fiat assets, and it continues to be there. I'm going to do a webinar on that next, which is going to be a story on Bitcoin and on crypto users. But for now, call this the obsession recession, and just trying to give you guys something to think about. I'll come back with another one at some point, but thanks for joining.